everyone. We are starting the panel section of this lovely event, Sky Connect. I'm Camille Russo with the Defiant. We have a great panel here on DeFi safety with Morpho, Spark, and Credora. Um, the most important topic of the season, I would say, DeFi safety. So uh, come join the discussion. We're at this moment in DeFi where it feels like a real turning point. I don't know what you guys think. Like the past few months have, really been about uh, seeing real institutional appetite and demand for on-chain assets, tokenization in a way that just you know wasn't true before. So uh, let's start with how what each of you think is the biggest risk in DeFi, especially now that institutions are starting to join. And together with your answer, if you could briefly say what who you are. I prefer that way instead of like having a long introduction of each panelist. Let's get straight to the content. So, Merlin.
Okay, so I'm Merlin, co-founder of Morpho. So Morpho is a universal lending protocol. So we are basically building a lending protocol on top of which anyone can build, earn, borrow, creation product on top, and there is close to 13 billions of total deposits in the space. So I think institutions don't realize yet that risk is multidimensional, especially in this space. So there's the smart contract risk, there's oracle risk, there's market risk, there's all those factors that are kind of blurry for institutions. And it's not about oh, we want to create that ideal product, we want to allow our users to borrow, but there's all those considerations that we need to educate and onboard people on this. So there's a huge education that we have to do, and also a huge work that we have to do on how do we surface every information that is accessible by anyone, because we are building on top of public blockchains, but still it's not because it's here that it's easily digestible by users, institutions. So we have to work on how do we make this digestible and fully transparent to integrators on top of Morpho, for instance, or other lending protocols. And this is where I guess we'll go into the risk rating, how to show that data, but there's a huge work that the ecosystem as a whole needs to do.
Hi everyone, Marcin here, co-founder of Redstone and also right now expanding Credora. Being honest, it's one of the most astonishing events I've ever been to, so congrats to organizers. If anyone would ask me if I would ever do a panel in front of a horse racing track, I would probably chuckle and laugh, but it happens. As Redstone, we are the fastest growing oracle in the market, protecting over $10 billion of asset, over 110 chains with 180 protocols, including Spark, including Morpho, Compound, Euler, and so on and so forth. Recently, 2 months ago, we acquired Credora Network, creating DeFi risk ratings platform together with them, which is live already on Morpho, going live on Spark very, very soon as well. So not only will be able to see the strategies on those protocols, but also the rating that is coming independently from our engine and our model. And talking about the question from institutional angle, I do believe institutions don't understand the most actually the oracle risk, because if I were to tell them, hey, there is hard-coded oracle, there is market price oracle, there is fundamental oracle, there is exchange rate oracle, and there's other types of oracle, probably regular institutional person is going to ask me, hey, but what an oracle is in general at all. So many of them think about, hey, this is this one piece that delivers the data on chain and to protocols, but the reality, 99% of the traffic that oracles deliver is the accurate pricing. So you can even go as deep as this is how the contracts are being executed, and smart contracts don't forgive. Like once you deliver once incorrect data, it's going to be executed and no one can revert it. And in TradFi, they're very much used to those kind of regular relays where you can call the office manager and you're going to revert the transaction or like bring back something that has happened over there.
Yeah. Hello, everybody. I'm Sam McPherson, co-founder, CEO of Spark. And yeah, so we're one of the stars in the Sky ecosystem, the great host of this event. Yeah, so what is the biggest risk? I think we saw, maybe this cycle is over, maybe it's not, but in this last cycle, there's sort of the cycle of getting the highest yield possible. And these things, I think it's important to highlight, are not risk-free. There's nothing that's risk-free if you're earning interest. And so I think there's this race to sort of get the highest possible yield is quite a dangerous place to be. And so this is why I'm supporting efforts to get risk ratings within DeFi. I believe in individual liberty and user choice, but I also believe we should do everything we can to make sure that users are aware of what they're getting into, because what can happen, I respect an individual's right to go into some crazy thing that might explode. That's their own choice. The problem comes is when these shift from individual choices collectively becoming systematic risk for the entire ecosystem. And so if we don't address this problem head on, and we have some sort of massive blow up event again, then the regulators are going to come in and shut the whole thing down. So we need to be proactive with this to allow DeFi to remain open and permissionless as much as possible.
Yeah, I think especially in what happened in the past couple of weeks, with Stream and XUSD and all these more like riskier collateral types, the lending DeFi lending really came under a lot of scrutiny into what the different architectures and models look like. And so Spark and Morpho have different architectures, different ways of providing lending and borrowing. If you could maybe detail what your differences are. In the case of Stream, I think kind of what people started questioning was this curator vault model, which I think kind of Morpho is leads more strongly toward, but I know that Spark also has its own kind of curated vaults as well. But what do you think? I mean, do you think that kind of heightened scrutiny around vault curation is fair, or what are you?
I think it's fair. As Sam was saying, that we need diversity of product, we need diversity of options for users, but that does not mean that we should let users decide and say oh, you should do your own work and that's it. We have a lot of work to do on surfacing the information at the market level. I think, as I said, risk is multi-dimensional, and risk rating is the capacity to bring that to one single dimension and to ease the choice for retail users. But coming back to the design architecture, it's Morpho coined the curator term, actually. 1 year and a half ago, there was no risk curation of things. We had that centralized lending pool model where everything is pulled together. It's one size fits all model. So it's great from a UX perspective because it's simple. You just click and deposit and yield. But you don't have a choice. You have one risk profile that is targeted. But if you want something with lower risk or higher risk, you don't have that capacity. Why with Morpho, it's less of fun. It's more like an infrastructure on top of which you can create funds or banks or whatever product on top. And so you can create markets that are totally isolated, and you have those vaults on top. And a vault can be spawned up by a risk curator, and this risk curator could have different vaults for the same asset, and those vaults would deposit liquidity into different markets. And so you could have a risk vault, higher risk vault. If something bad happen on that high risk vault because it's depositing into a market that get rugged or whatever, it does not affect the lower risk. So we think that this model, this design is the only way that can scale and cater to the many different risk profiles that exist because it's continuum, and to the 8 billions of users, because everyone needs something specific. And, and so you'll have vaults that run indefinitely without any issues, and some that will blow up, or some that will have some bad debt, or etc. And that's part of the lending. That's because you take a risk, so you earn yield because you're taking that risk. You're receiving rewards, but as Sam was saying, there's no risk free rate. There's no free lunch. But our job is to surface that risk then to users so that they understand and they can take informed decisions.
What do you think, Sam?
Yeah, but like stream finance in particular, or like the curation model. I mean, yeah, okay. So like, there's already multiple curators in the space. I view like the modular lending infrastructure as pretty inevitable. I think it's crazy to assume there's going to be one risk curator that is like, you know, running the bank of the world, and you know, all the assets are in one pool. You know, we have a pooled lending market internally. We're the second largest Spark lend. But we don't list every single asset in there. For example, for looping, we did looping with Athena, for example, and Pendle. We would use Morpho for isolated markets because it's the right tool for the right job. In traditional lending, these are the types of you use these different tools, you charge different rates, you have different LTVs and these types of things like in separate pools. And so Sparklend is focused just on doing crypto loans, CDB style loans with Bitcoin, ETH, LSTs, LRTs, and it's just going to stay that way because that's the risk profile of those assets. And so we're confident in just delivering Sparklend as an institutionally friendly market that it caters to that one particular use case. We're not rehypothecating the collateral, and we're just doing stablecoin lending. So I think for that, we're using the pooled lending market, but we also have the tools available in Morpho. And with all these RWAs coming on chain, the risk profile is not the same for every asset in the world. So like, clearly you need to have isolated markets.
And Marcin, with kind of the heightened complexity that's happening in DeFi, with all these different collateral types, all these different vaults within one protocol, how do you make sure that with a ratings agency, how do you communicate the risk? Because one there are many different risk profiles within one protocol, right? So do you have to like do the job of like having an overall protocol rating, but also like a per vault rating?
Yes, that's correct. So whenever with Credora we do a rating, we look at the particle protocol, may it be Morpho, may it be Spark. Then we also look at the composition of the assets that are in particular vault. It can be only 2 assets, but it can be also plenty of assets. So we look into every single asset that is within the specific vault. We look at probability of significance loss, or like even the default. We look into the oracle risk, so whether it's hard-coded. For example, in Stream Finance example, some of the vaults were hard-coded with $1 value, which happened to be pretty dangerous because the actual XUSD started to plummet, right? Like in terms of the real value. So there is a number of factors we put into consideration, and the methodology that we have right now with Credora is highly automated. So the final result comes from the methodology, from the engine, and then we are just fine-tuning the final rating so that we ensure it makes sense. We also simplified the rate, like the scale, very much in comparison to TradFi. In TradFi, you have from triple D to triple A plus, and for regular user, it's pretty hard to say what's the difference between BB and BB plus. So therefore, we just made it simple from D to A plus. So some of those buckets are just sticked together. But in general, I think in crypto we have a problem of ADHD. And to check whether anyone still is listening to us, I have a question to the audience. When was the last time you allocated into a Vault or DeFi strategy for a year, 12 months, and you didn't touch that money? Okay, maybe I would call it 10%. And the reason is why we even talk about APY, which is the yield that you're getting throughout the year. When we are looking for a new yield strategy every month, we are moving the money and we're depositing into a new farm and into new places. So for those kind of users that are just chasing for the highest yield opportunities, it's true that the ratings might not be the most useful one, but I do believe as we go towards the general adoption of crypto products with Morpho Spark appealing to new users, those kind of people will care about rating a lot because they will not understand all the opportunities that are in crypto. They are not going to follow crypto Twitter every single day like we are. We are absolutely addicted to crypto Twitter. Really? Did you check crypto Twitter today? Of course you did, and everyone of us has. But I'm talking about the general public. For them, such a simplified way of assessing the yield, let's call it 10%, and a rating A, and then another one, 15% rating B minus, gives them just more informative choice where they want to allocate the money. And it doesn't mean that the lower rating is not going to get an allocation. There are going to be still apes that are going to ape, but it's just about making sure that people understand what they're signing up for.
So Merlin, you talked about the need to better surface the risk for users, and I think you're totally right. I think for too long DeFi has been like, okay, we're just putting code out there, like the user will kind of figure things out and they can assess for themselves, like it's all transparent anyway. But I think it's part of like maturing for protocols to take responsibility and like what they are surfacing to users. So at Morpho, what are you guys doing to improve that?
So I think we are going. We're doing a more like a product shift in the sense that DeFi was trying to cater to every type of users, and you have like an interface with APYs, etc. A lot of information, but there's a lot of new users that are coming on chain and they don't know about what smart contracts in detail is, what is the risk of being maybe hacked, or what's the oracle risk, and all those kind of things. They don't know about this. So I think on our side, it's more we are going from more a retail users to a prosumer app where we are going to surface much more information, those risk rating things, more information at the market level, but target like more tech savvy users, and all the one that needs more onboarding education, or that don't know about and they don't want to know about what is underneath, then redirect those users to actually the fintechs of the world, the centralized exchange, the distributor that are building nice interface with a nice UX that is very simple to use, and those fintechs, those distributors will choose behind the scene. They will choose a low risk or high risk vault, and they will say low risk opportunity, high risk opportunity, and just do the choice. Versus on the Morpho app, you have 300 volts, and you have to decide between all those 300 volts. A retail users like my mother, she doesn't care about this. She just want 4% on my in my saving account. Let's go, and that's it.
So Sam, you talked about how Spark is going after kind of the safer, like blue chip options and collateral. How does that balance with the need to scale, especially with so many new options in the market where everyone is kind of going after really high yield opportunities and competing that way?
Yeah, it's a good question. So, the savings product as it is today is delivering 4.5% yield, and we feel that this is the best at-scale risk-adjusted yield in the market at this size. So, the liquidity profile is $9.3 billion in total deposits right now, and so yeah, it's proving itself. There's been growth by 1.5 billion in the past month. So this is clearly emerging as the place where capital moves to safety. But yeah, there's definitely interest in higher yielding vaults, and so we have vaults on Morpho that are specifically like going in, not anymore, but they were going into like the PTs for Athena, specifically like mostly in September. So these vaults are open to anybody; they can deposit. These are Spark run vaults. But yeah, we're always onboarding different opportunities. So like we've gone into Athena before, but we're exploring offering more high yield, more direct access to the basis trade through like a Spark Run product. I think is a good idea, and so it's clearly there's market demand for that. So it's basically providing as many options as we can. There's no reason we shouldn't.
I'd love to get the opinion of the entire panel about what what can we do to make the whole experience safer. Besides, like credit ratings, surfacing information is great, but something that's similar to kind of insured deposits, is something that is like a backstop for when like big hacks like Balancer happen. Because like when the Balancer hack happened, I think it shook DeFi pretty, uh, to its core, because it's a protocol that's been here for since the very early days. It was audited a billion times and so on, and even that didn't prevent the loss of funds. So is there something like an insurance or a DeFi native insurance that we can apply that goes kind of beyond like surfacing risks, but that actually kind of makes users whole if there's a hack when that happens?
I can speak to this. Yeah, so for USDS, there's multiple layers of insurance that come with the protocol. So as the star that's allocating Spark, we take first loss on the investments that Spark is choosing to do. This is just put like skin in the game. It's classical sort of incentive structures. So if there was some loss, the idea is that first it would be covered by the excess surplus available in Spark, which is currently about 33 million. And then it is then backstopped by the SPK token. There's then losses going up to the next layer, the sky layer. It is also backed by surplus buffer. And then finally, there is the token backstop, which still exists, where there's the token will be minted to cover the losses. So all these layers of insurance are very important for providing assurances to USDS depositors. Stablecoins are meant to remain stable, and so the first job of a stablecoin is to make sure that there is not losses going back to the most senior position, which is the USDS holder, which is protected through all these layers. So this is the design of the star system, and it's meant to both able to react to market conditions by allocating to good risk-adjusted yield opportunities within crypto, as well as putting skin in the game on the stars who are making these decisions and making sure there's layers of backstop so that USDS holders are always the top priority for making sure there is no losses going back.
Yeah, I do believe as the ecosystem matures, we are going to see more and more insurance being offered, especially on the most blue chip strategies. For example, looping of LSTs like Lido, EtherFi, looping stablecoins, and so on and so forth, where I'm not talking about the degen stuff. Over here, I see three options. The first one that is happening already are restaking protocols utilizing their capital for insurance, essentially. So Symbiotic, Eigenlayer, they have like a pile of cash laying on the protocol, and they have to do something with it, right? So insurance is one of the ways to utilize that capital, and I know they are actively working on it. And here Credora can come in very handy in the sense that if something is getting an A+ rating, it can diminish the cost of the insurance that is like the margin that is paid for the insurer to ensure like the payout is being delivered if any black swan event happens. The second area that is, in my opinion, 5, maybe 7 years away are the proper insurance companies like Lloyd's of London actually insuring the on-chain risk. I did have 2 of such conversations with proper TradFi insurance companies, and they say, no way. And then I do believe after the Balancer hack, it's going to be only worse, right? Because for those guys, like they look at the at the industry to create profit at the end, right? So they are serious people who have serious models, like analyzing the risk, and for them, DeFi is a young industry, being honest. So I would imagine first mover coming from the more crypto native industry companies. If there's going to be a proven model from crypto ones, then the institutional ones might come over, which was the same with DeFi and tokenized assets. And the third one, that is a fun one, we can use right now prediction markets to do some sort of insurance. So I saw there are polymarket markets, for example, is new DeFi protocol with above 100 million TVL going to be hacked until the end of the year. So if you want to buy some sort of insurance, you just buy yes on that side of a sort of a market. You're going to lose if it's going to be the one that you're using, but then you're going to at least get a payout on the prediction market. That one is a fun one, but maybe there's going to be something to it.
Not financial advice. On the second point, I think that could move faster because if institutions are coming on chain, they will ask to their insurance partners, hey, we want to be insured about that. And if they're, I think they are moving in the next 6 months, 1 year, given the conversation we have. And when they will ask, I'm sure insurance companies will will look at DeFi more closely and will be forced kind of to move ASAP and insure deposit into lending protocols. So I think 7 years may be a bit bearish, but it will take time.
I take your word for that. 12 months and I get an insurance on Morpho from Lloyd's of London. Okay, I get it.
didn't say. Okay. No, but and as you say, there's many insurance companies in crypto that are Nexus Mutual. You talk about Symbiosis that are here, that they've been here for a long time. And talking about with institutions, they are more and more asking that how can we get insured about that. Obviously, in TradFi right now, you don't have this opportunity, so they will turn to the DeFi options, which is great for the ecosystem. And I think this is a part of the solution.
Awesome. Okay, so we went over just DeFi protocols taking more responsibility in surfacing the different risk levels of their offerings, credit ratings, and crypto native credit ratings being an important part of it, being very restrictive or conservative with the collateral that is added to lending protocols as well, and also offering kind of users choice on how they want to deploy their money as that's happening. And finally, the still kind of nascent insurance part of the equation, always to make DeFi safer now that institutions are finally coming to play. So thanks guys, this was a great panel, and thanks everyone.
Thanks, Camila.
Take care.
Thanks a lot. Cheers.